Rogers reported its first quarter results, just missing earnings per share estimates, but meeting on revenue. Let's bring in David Heger. He's senior equity analyst at Edward Jones. Thanks for joining us today.
Good afternoon.
So the company was expecting a drop in new wireless customers. Tell me what that was based on and how many new customers did they actually end up getting?
Well, the company was expecting a slowdown across the industry. I think most analysts were anticipating that as well. The Canadian telecom market is being impacted by a change in government immigration policies, and therefore population growth has slowed. And in turn, that's affecting the amount of growth across the wireless industry. And certainly Rogers saw that in its wireless business. In terms of postpaid subscribers, which are the highest value subscribers, Rogers added a net 11,000 subscribers, which was a little better than expected, but certainly a pretty dramatic slowdown from where they were a year ago, reflecting both the tough competitive environment in Canada and also the slower population growth.
Got it. Now, you still see the company as a buy, and you're basing that on its deal to buy Shaw. Tell me a bit more about that.
Well, since acquiring Shaw, Rogers has been able to rationalize a lot of costs across the combined businesses, and has seen a pretty significant improvement in its profit margins operating on a combined basis. So, the company has really, I'd say, over-delivered in terms of the amount of cost savings and benefits from combining the two operations. That's happened, though, as the competitive environment in Canada has gone a lot tougher. And so we've seen pricing pressure for wireless services. And, that's over the past year or so had an impact on revenue growth from wireless and across the industry. And certainly Rogers has faced that. But then secondly, more recently, as I said, now we're seeing a slowdown in population growth, which is further causing the wireless industry growth to slow down. So, my view is that Rogers has executed well since completing the Shaw acquisition, but has also at the same time faced a much tougher competitive environment in Canada. Are you worried about
leverage or debt with this company? They've made some big money deals, and we'll get to them in a moment. But are you just worried about the balance sheet?
Well, we have had some concerns just in terms of the increase in debt to complete the Shaw acquisition. The company, after the acquisition, had gone all the way up to over 5 times net debt to EBITDA, which is a fairly high leverage ratio. Since that time, they've brought that down into the 4 range with paying down debt plus some growth in EBITDA. But now the company has a pending transaction in which it's going to sell off ownership in part of its wireless infrastructure, which that will help further bring down debt levels. More, the company is indicating down into the mid-3 range, which we do view that favorably, just in terms of getting the debt leverage in a better position, improving the company's overall financial condition.
Okay, so that's the deal with Blackstone and some of the pension companies as well. On the flip side, they're acquiring BCE, which is the parent company of this channel under the Bell Media brand. They're acquiring the share of Maple Leaf Sports and Entertainment. So again, a big money purchase there. Will this serve them well?
Well, I think what Rogers is looking at is the pretty dramatic increase in value of sports properties across both Canada and the U.S. The professional sports teams have been seeing increased valuations and high investor interest. And so I believe that Rogers made the decision to buy out BCE, to take full ownership of Maple Leaf Sports and Entertainment as a way to take advantage of those rising valuations. And it sounds like the company may be having some initial discussions with investors who are interested in potentially making some type of investment into the Maple Leaf properties.
So they've also spent or want to spend about $11 billion for their NHL deal, and that's twice what they paid for the last contract for the television rights. Are they getting that much value out of hockey?
Well, there certainly could be a lot of argument about whether they can derive value out of the, with the much higher rights costs. One of the things that I think Rogers will do is they likely won't keep all those rights themselves, and we saw that with the previous contract where they basically sublet, if you will, some of the rights out to other media companies. And I believe the new contract includes streaming rights, which there may be ways to monetize some of those streaming rights as well that Rogers is looking at as a means of offsetting some of the higher costs for the new contract.
Did they share some guidance today? I'm just wondering what was in it and what struck you from the guidance.
Well, for the basic business, they maintain the guidance that they gave at the beginning of the year, which reflects just kind of low single-digit revenue growth and EBITDA growth, reflective of the challenges in the Canadian telecom market. Now one thing that did stand out to me just within the report numbers was the media business actually had some upside as the company is seeing some benefit in terms of sports revenue and also the takeover rights from the Warner Brothers Discovery cable channels provided some benefit and will likely continue to through the year. And we would think that the strength they've seen so far in sports may carry on through future quarters in 2025.
Okay, so their biggest bet moving forward, though, is definitely on sports.
Yeah, certainly that's the latest and pretty significant bet that they're making on Maple Leaf Sports and Entertainment, which it seems as though the management sees opportunity though to capitalize on that ownership and potentially find ways that could, I think, help further improve the balance sheet by possibly monetizing some of that ownership.
All right, David Heger is the senior equity analyst at Edward Jones. Thank you for your time. I appreciate it.
All right, thank you for having me.